This content reflects my personal views and current market trends. It is provided for informational and educational purposes only and does not constitute financial, investment, or trading advice. I am not a licensed financial advisor. Always conduct your own research and consult with a qualified professional before making any investment decisions. Investors who understand the macro landscape right now won't just survive, they'll lead in the next market cycle. You're watching history unfold, and most investors are completely missing it. 2025 isn't just another market cycle, it's a full-blown macro regime shift. U.S. stocks crashing, crypto obliterated, the almighty dollar in freefall. Meanwhile, gold is ripping to record highs, and while government bonds surged earlier in the year, recent volatility, particularly in U.S. and Japanese debt, has rattled fixed income markets, and international markets are quietly outperforming. What triggered this sudden reversal? A single day, April 2nd. That's when the U.S. unleashed a wave of reciprocal tariffs that flipped the global order on its head. It wasn't just a trade move, it was a message. The old playbook of globalization, cheap capital, and buy the dip is dead. Investors are facing a harsh reality. The U.S. is no longer the safe haven it once was. For the first time in decades, we're seeing capital flow out of U.S. assets. Corporate bonds are experiencing the largest foreign sell-off since 2020, cash outflows are significant, and even favored tech stocks are losing traction. Yet, while headlines shout about recession, fear, and collapse, smart money isn't panicking. It's rotating into gold, bonds, and international equities, into safety, and into what's next. The traditional 60-40 investment portfolio is struggling in today's climate. More investors are shifting to a more resilient, diversified strategy across cash, bonds, gold, and equities. These portfolios are designed for uncertainty and are already showing stronger performance in 2025. And if you're still all in on the S&P, hoping for a Fed rescue, you might be on the wrong side of history. Because without rate cuts or tax pivots, this market won't bounce. It'll bleed. However, there is a potential upside scenario emerging. The initial phase may involve front-loaded economic pressure, driven by tariffs, regulatory tightening, and policy shocks, but that could set the stage for a strategic pivot. Should we see a shift toward pro-growth measures such as tax relief, deregulation, monetary easing, and declining yields, the conditions could align for a significant market rebound in the second half of the year. This isn't about fear, it's about being prepared. The market is changing. Volatility is becoming normal, inflation isn't going away, and policy decisions are moving prices more than company earnings. So the question is, are you still investing based on the past, or are you getting ready for what's coming next? Because the people who will do well this decade aren't the ones following old trends. They're the ones who saw the change early and adjusted before everyone else. If you're done following the noise and ready to lead with insight, subscribe to Macro Junkie. Hit that bell and stay locked into every major shift before it hits the headlines.